Good morning, and you're watching the first of a 5-part series designed to pivot your investment strategy from passive loss to fortify and grow. This series is not about tips, it's a fundamental audit. The data confirms a hard truth. A 7.5% FD is currently outperforming 58% of active equity funds. In the structural shift of 2026, the easy money has evaporated. So if you're still running on the 2019 playbook, your capital is effectively trapped in zombie assets. Investments that look fine on your app but are functionally dead in the real world. So we are here to answer one question. Why is your net worth losing purchasing power despite you doing everything right? Over the next 4 episodes, we will move from this audit to bulletproofing your portfolio against inflation and future-proofing your wealth for the decade ahead. Look, we understand balancing a 9-to-5 job with active investment focus is a high wire act. So we will, over the course of next 4 episodes, try and make it as easy and clinical for you to understand. So first step is that you open your portfolio and find your XIRR. If that number is lower than the 2026 inflation rate, which is 4.6%, you are not an investor. You are just the exit strategy for someone else. And before we move on, make sure you hit that subscribe button so that you won't miss out on the next 4 episodes. So let's fix that trajectory. Since April 2023, the Indian retail investor has been sold a compounding mirage. Let's look at the cold maths. If you deployed 12,000 monthly into a Nifty 50 SIP starting 3 years ago, you would have committed capital of 4.32 lakhs. The reality, your current corpus likely hovers around 4.3 lakhs today. On paper, it looks stable, but once we account for the 4.6% CPI inflation and the 2025 LTCG revisions, your real term growth is actually negative 2.1%. So you are not staying the course. You are providing exit liquidity for institutional players who are rotating out of overvalued Indian equities into high yield debt. When your net worth loses purchasing power while you are investing, you are not an investor, you are a subsidizer of the market. Mainstream media relies on 20-year historical average to sell you mutual funds. They quote 12% returns because it's a comfortable narrative. So you've been told that volatility is your friend. But that is half truth designed to keep you from selling. In a market where growth is stalling and inflation is persistent, volatility is not an opportunity, it's like a slow leak in your net worth. So every 10% swing in a flat market erodes your capital while you wait for a breakout that the technicals don't support. The smart money has already moved into short duration debt and arbitrage fund. The gap between what you see on the news and what is happening in order books is where your wealth is being lost. Now that we have diagnosed the problem, we move to the solution: portfolio hardening. Think of this as an armor upgrade for your wealth. Most of us have built our lives on 5 specific foundations. You know them well because they represent your hard work. The monthly SMS from your bank for your SIP, the EMI for your home, the gold in your locker, and the FDs you keep for peace of mind. These are the 5 pillars of the modern Indian portfolio. But here is the danger. While these pillars look solid, the ground beneath them has shifted. In 2026, many of these are no longer supporting you. So let's audit them one by one. First is the SIP trap. Most of you are running a blind SIP. You put in the same amount every month regardless of whether the market is at an all-time high or a temporary low. Think of it like driving a car at constant 100 kilometers an hour, regardless of the road. You stay at 100 while going uphill, you stay at 100 while you're going through a blind curve. It's a fixed strategy for a world that is not fixed anymore. Without a system to invest more when the price is low and take some profits when they're too high, you're not really compounding. You are just paying to wait while the professionals are trading around you. The second one is FNO. It is the liquidation engine. With the Nifty's current 1000 point weekly swings, retail leverage is being hunted. If you are not hedging your bets, you are not a trader, you are the yield for the big house. Third one is real estate. Your Gurgaon or Bangalore apartment might show a 20% gain on paper, but transaction velocity, the speed at which you can actually get cash, is down 40%. Try selling that house in 30 days without a massive haircut. That is a liquidity trap and it is not an asset. The fourth one is gold. It's a great shield against a falling rupee, but it is a zero yield asset. It's insurance, not an engine. It stops you from losing, but it does not help you win. And finally, the fixed deposits. Even at 7.5%, once you factor the 30% tax bracket and 4.6% inflation, your real return is effectively zero. You are essentially parking your cash in a melting ice cube. The era of passive accumulation is over and you don't need better luck. You just need a strategic pivot. So your 48-hour survival checklist starts now. Calculate your post-tax XIRR. Open your spreadsheets. If that is under 3% for the last trailing 12 months, your current strategy is a liability on your investments. And most of all, please verify your subscription. Ensure that you have access to episode 2, which will be dropping in 48 hours. In the next episode, we will be talking extensively about fixing the SIP flaw that we have identified today. So let's start this series with a motto that we don't just invest, we actually architect our portfolio for survival. And thank you for tuning in and thank you for your time, and I will see you in the next episode.